Hi founders, welcome to another episode of Know Your Term Sheet. This is a series of videos where I help demystify the standard VC term sheet so that first time founders like you know what you're signing up for. If you have been liking the content that I've been putting out, please do hit those like and subscribe buttons. That will help me reach out to even more founders. Today we are going to be discussing another term in the term sheet called tag along rights. But before we delve into that topic, I wanted to quickly talk about why all these rights are placed by investors at all. What you need to understand as a founder is that you are signing up for a very specific type of capital, venture capital, that is a very recent phenomenon of high trust societies. For most of history, if you wanted money to build a business, you had to borrow it from somewhere and then you have to pay that person interest on that money. You have to pay the money back after a certain time period, and you also have to give collateral for that money so that if you don't repay, they can still recover their money. The only other option was to raise equity money, but that would automatically mean that you give up most of your company on day one. In fact, it was common up to the 90s for VCs even to own majority stakes in businesses that they would invest in. That sounds crazy by today's standards, but think about it. For the first time ever, entrepreneurs could now get money by selling a stake in a business that didn't even exist. Today, good VCs understand that they need to let the entrepreneur run the business. It is their company, and a VC is only an investor. By giving them significant ownership and complete operational freedom, the founder would be best incentivized to make this company a huge success and thereby give the VC an extraordinary return on their investment. Why I brought this up is because of the keyword incentives. VCs are basically giving you money with no collateral. So hence they put in all these other rights and terms that I've been talking about, with the goal being of aligning the founder and the VC's incentive for the long term, which is also aligned to the company's success. With that backdrop, let's discuss tag along rights. This is an important, standard and fair ask from an investor who wants to invest in your company. It basically means that if you as a founder sell a percentage of your own shares in the company to someone else, then you also have to get that buyer to buy out the pro rata percentage in your investor shareholding of the company. What does this mean? Say for example, you're two founders, you each own 50% in the company, and you now raise $1 million for 20% of the company. This is money which is going into the company for its growth and future expansion. This $1 million is not coming to you as the founder, right? But it's going to the company so that it can build product, hire a team, etc. etc. Now you each own 40% of the business after giving 20% to the investor for $1 million. And out of thin air, your stake in the company, which was worth zero, is now worth $2 million each, right? Because you own 40% of a $5 million company. Now, let's say you meet a new investor who's very excited about what you're building and he wants to own a piece of your company. And this new investor offers you $1 million for 10% of the company, which means you and your co-founder could each sell the 5% ownership in the company and pocket a cool $50,000 each, right? For a pre-product company with no revenue, that's a great deal, right? Nope, that's exactly what is your VC's nightmare. The VC model works on a long-term incentive alignment between the founder and the VC, which means they give you money to build a company in which they own a minority percentage. If this company works out, then you both make a lot of money. If this company doesn't work out, you don't make money and they don't make money. One of the principles on which they give you this money is that you will not make money before they do. Okay? Because if you make money before they do, then one, you might lose the motivation to work as hard now that you've already made some money in life. Two, founders are supposed to be in the startup business to build long-term valuable companies. If they start selling their shares too soon, it signals that maybe they don't really believe in the long-term success of this business and hence want to cash out now. It could also signal that something is wrong with the company because the founder knows the company better than anybody else. Three, this signaling will make it much harder for you to raise money later on, right? And four, is it fair to the investor, right? Given that the company has a value only because they gave you money in the first place. So shouldn't they make their money back before you make yours? So say if the company shares have an interested buyer, the VC will always want to have the option of selling their equity before the co-founder does, or at least along with the founder. Because remember, they have to return this money to their own investors. So given the fact that they gave you all this cash for an unproven business, I think it's a fair right. So this is not a right you should fight with a VC on or even an angel on. Pretty much nobody will give you equity money without a tag along right. In fact, VCs might also put in an additional term like if you sell more than 50% of your shares, then you need to get them a full exit if they want to. This is also fair in my opinion because the founder selling more than 50% of their shares is signaling that they no longer believe in the business, right? If the captain of the ship has jumped overboard, it's game over for everybody else. Does this mean that you can never sell your shares in the company without your VC getting an exit first? Not really. Most VCs understand that life has other compulsions. You may need money to get married, to buy a house, for your kids' education. So if you're selling a small percentage of your holding and you're selling after the company has established product market fit, maybe you've raised Series A, Series B in funding, and you're clearly doing well, the VC will not have a problem, and they'll in most likelihood either waive off this tag along right, or they might buy the shares themselves from you. There are a couple of other terms that they also put into sort of lock-in long-term founder incentives, which are founder vesting and founder lock-in. These also address similar risks for the investors, but we'll cover them in our future videos. So that's it for this one today, folks. Feel free to leave your comments below. If you think I said something wrong, or if you think you have a different point of view, I would love to hear it. Also, please don't forget to subscribe and like on this channel so that we can reach out to even more founders. See you in the next episode of Know Your Term Sheet. Keep building, keep hustling. Cheers.